Welcome back to Investing Talk Podcast.
Today we're looking at Qualcomm. The big question is it a good time to buy now?
We want to hear from you. Subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We have a pretty clear consensus from the sources we looked at. Sentiment around the stock right now, it's overwhelmingly bullish, rated about 8.5 out of 10.
8.5, okay. Pretty strong.
Yeah, and the core driver for this optimism seems to be, well, accelerating growth outside of their traditional legacy segments. Smartphones.
Right, moving beyond handsets. Let's unpack that recent momentum then, because the execution seems pretty impressive lately. What have the financials shown us in, say, the last 3 months or so?
It's been excellent execution, really. If you look back at Q3 fiscal 25, revenue hit $9.5 billion. That was up 13% year over year.
Solid growth.
Very solid. And even more recently, the September data showed that momentum continuing. Revenue climbed again, 10.3% year over year to $10.4 billion. And net income, that surged over 25%.
25% on the bottom line. That's significant.
Exactly. It's not just growth, it's profitable growth.
Okay, and that leads right into the stock's performance, its resilience. It's gained, about 40% since those April lows? Basically recovered everything it lost over the summer.
Yeah, it's quite a recovery.
So has the easy money already been made here? Or does the institutional interest we're seeing suggest this rally might actually have legs?
Well, the sources strongly suggest this is more of a structural shift, sustained momentum, not just some technical bounce.
Okay.
Institutional confidence seems remarkably strong. We saw that key upgrade in late October 2025, Weiss ratings bumping them up to a buy B. That's signal an improving outlook.
Right, the B rating.
And you mentioned filings, Keeler Thomas Management. They acquired almost 19,000 shares, adding to their position. So, smart money seems to see a strengthening foundation.
And connecting this to the bigger picture, the strategy.
Right.
The sources really highlight some key maneuvers here. Let's talk about that big AlphaWave acquisition. $2.4 billion announced and closed back in August. Why spend that kind of money? What does it actually buy them?
Oh, that deal is absolutely pivotal. And it directly addresses, I think, the future of AI infrastructure.
Okay.
AlphaWave, they specialize in high-speed, low-latency connectivity IP. Think of it like the digital plumbing, basically.
Got it.
So this acquisition immediately boosts Qualcomm's position in two massive growth areas, AI inference and data center connectivity. The long-term potential here, it's not just about selling more chips. It's about making sure their next-gen processors can communicate incredibly fast inside those huge server farms.
So it's like an infrastructure play, but through a chip acquisition.
Exactly. That's a good way to put it.
So the core argument for buying, then, it seems to really hinge on this diversification working. Moving beyond smartphones, how much traction are these new segments actually getting? What are the key growth engines driving this shift?
Yeah, that's really the heart of the investment thesis now. I mean, their core QCT segment, Qualcomm, CDMA technologies, that still grew a respectable 11% year over year.
So growing.
Right. But the real acceleration, the excitement, is coming from IoT and automotive. Management's being pretty bold here. They're projecting those two segments combined to hit $14 billion plus in revenue by 2029.
$14 billion. That's a huge target from segments that used to be secondary.
It's enormous, and it signals a major shift away from just relying on that cyclical handset business.
Okay, but $14 billion is aggressive. It definitely brings up the competitive moat question. Why are they succeeding here? What stops rivals, like NVIDIA or Intel, from just coming in and eating their lunch, especially in auto and IoT?
It really boils down to a couple of things.
Yeah.
First, it's their deep, long-standing relationships with the major OEMs. We're talking Apple, Samsung, Xiaomi. That gives them huge scale and, frankly, testing advantages.
Right, the existing partnerships.
But second, and probably more important for the future, is their leadership in AI at the edge. That's driven by their Snapdragon platforms.
Okay, let's pause there for a second. We hear AI at the edge a lot. Can you quickly define why that's such a durable advantage for Qualcomm specifically?
Sure. So AI at the edge means processing data right on the device. Could it be your autonomous car, a factory robot, an industrial sensor, whatever. Not sending everything back to a central cloud server.
Okay, local processing.
Exactly. And that requires chips that are incredibly power efficient, but also have very low latency. Qualcomm's Snapdragon architecture is, well, uniquely optimized for this kind of low power, high performance job.
And that's key for cars, right?
Absolutely critical for automotive platforms.
Yeah.
Instant response, low power draw, those are non-negotiable safety and efficiency features. It gives them a really defensible position against competitors whose chips might need more power.
Makes sense. Now, we can't talk Qualcomm without touching on their foundational strength, that patent licensing model. Highly profitable, yes, but also frequently targeted in lawsuits. How do the sources weigh that risk versus the cash flow?
Yeah, that's the constant tension, isn't it? And it's probably why the valuation stays, well, somewhat depressed compared to peers.
Oh, yeah.
Their licensing arm generates incredible, sticky cash flow. It's basically an annuity funding their R&D.
Right.
But the legal and regulatory risk, it's always there. Every few years, there's litigation, often from OEMs or regulators questioning the fees.
So it's a drag on the multiple.
It definitely is. But the sources note that with the diversification into chips, into QCT, and the strength of their balance sheet now, they have more of a buffer against any, adverse ruling they might face down the line.
Okay, let's pivot to fundamentals and valuation then, because this is where the bull case seems to get really interesting. Are they priced like a high-growth AI play, or is there still a discount here?
This is what's fascinating, the valuation disconnect. You look at companies delivering this kind of double-digit growth, executing this aggressive AI diversification.
Right.
Their peers in the semiconductor space, often trading at 30, 40, even 50 times forward earnings.
Yeah, those multiples are high.
Qualcomm's PE ratio, it's sitting attractively around 16.
16.
Feels low.
It really does. It suggests the market still kind of views them mainly as that cyclical handset company and hasn't fully baked in this non-handset transformation we've been talking about.
And financially, they seem rock solid. $10.6 billion in cash and short-term investments. And the quick ratio looks healthy at 1.45. They can cover immediate debts easily.
Exactly. And look at the free cash flow, about $8.2 billion over the last 12 months.
Wow.
That gives them plenty of capital for R&D, for strategic buys like AlphaWave, and for capital returns. That free cash flow yield is significant. And it's the main fuel for that potential dividend hike analysts keep mentioning. Okay, but let me play devil's advocate here. If their main driver is still the cyclical handset market, how much of that cash do they need to hold back just in case of a downturn rather than, guaranteed dividend hikes? Are they maybe being a bit too conservative with that big cash pile?
That's a fair challenge, actually. Management has historically been pretty conservative, yeah. Using cash for strategic debt reduction, buybacks when the stock dips.
Right.
However, the sources seem to suggest that the sustained performance and diversification auto IoT is maybe reducing the need for such a huge safety net.
Oh.
If the Q4 guidance shows further acceleration in those areas, it signals the cyclical headwind is less impactful, and that could free up capital for a more substantial shareholder return. It really all hinges on near-term execution.
Which brings us perfectly to the immediate catalysts. The next 3 months look absolutely packed with events investors need to watch.
Yeah, the big one, the unavoidable one, is the Q4 and full fiscal year earnings call. That's scheduled for November 5th, 2025.
Right around the corner.
The market kind of knows earnings will likely be good, given the recent performance. The real potential shockwave, though, will be if management dramatically revises that 2029 $14 billion target for auto and IoT upwards.
Raising the guidance.
If they signal that diversification is happening even faster than expected, that could really drive a breakout above that key $180 technical resistance level we're seeing.
Okay, so earnings guidance is key.
Yeah.
What else? There are market structure events too, right?
Correct. You've got major ETF and index rebalancing coming up in December. That can sometimes drive forced buying from passive funds. Then in January, the institutional holdings update. That'll show us exactly which big funds bought in during this recent run-up. Plus, holiday sales reports in December. That'll give a read on consumer momentum for IoT and handsets going into 2026.
What about those higher risk, higher reward rumors floating around?
Yeah.
About their long-term strategy?
Oh, the rumors are juicy. One piece of industry chatter suggests they're actively trying to accelerate their high-end AI data center chip launches, potentially pushing them into mass production well before that planned 2028 timeline.
Really? That would be big.
Huge. If they pull that off, it significantly closes the gap with the established data center players. Separately, there's persistent talk about a large, undisclosed European auto OEM adopting their full automotive platform.
A major auto win.
Which would immediately validate those long-term growth targets we talked about.
Okay, let's quickly touch on technicals before we wrap this up. Stock looks strong, right? Trading above key moving averages.
Yeah, technically strong. Consistently above its 50-day moving average, that's around $173, and the 200-day, which is down at $161. Near-term resistance looks like it sits just a bit higher, around $187.
Okay. And finally, the risks. We have to acknowledge why it might still be trading at that 16x multiple.
Absolutely. We have to return to the risks. The primary company-specific ones are the classics, really. Cyclical handset demand is still a factor. Ongoing litigation around licensing is always a possibility. And of course, client concentration with giants like Apple and Samsung.
The usual suspects.
Pretty much. But as we've discussed, that strong balance sheet and the active diversification effort provide a pretty robust risk mitigation strategy, especially during broader macro headwinds. So the overall investment thesis suggests Qualcomm is, well, uniquely positioned right now. It offers a valuation you'd normally see in more mature legacy companies.
Right, that 16 PE.
But with clear, confirmed paths to secular growth driven by AI and connectivity diversification. The outlook really hinges entirely on robust execution and, crucially, optimistic guidance coming out on November 5th.
So bringing all this research together, thinking about the listener at home, what's the single most important signal for investors tracking Qualcomm in November? The bull case seems clear, diversification, valuation, but like we said, the price has already run up 40% since April.
Yeah, that's the key question.
The key to sustaining this momentum isn't just delivering good earnings numbers on November 5th. It's about providing compelling, durable growth guidance outside of those legacy handset segments. That's the real signal. And maybe taking it one step further. If Qualcomm does manage to accelerate those data center chips and successfully close the gap on server incumbents, the next question for you to explore is, which major cloud provider will be the first to drop a competitor and actually adopt this new Qualcomm architecture? That adoption, perhaps even more than the earnings report itself, could be the true breakout indicator to watch for.